Do you want to lose your fortune in real estate investing? Do you want to learn from others, failures, and avoid disaster? The answer is simple. Understand the 5 fatal failure patterns. Judge by numbers. Eliminate emotion. Why does this work? This slide explains everything. Most people who fail in real estate repeat the same mistakes. Failure number 1, emotional purchasing. Buying because I like this property. That's consumption, not investment. Failure number 2, overpaying. Ignoring market prices and buying at inflated values. You've already lost from day 1. Failure number 3, ignoring cash flow. Looking only at rental income while underestimating expenses. You're bleeding money every month. Failure number 4, insufficient capital. No buffer for repairs or vacancy periods. One problem bankrupts you. Failure number 5, inadequate market research. Buying without analyzing demand or competition. You end up holding a property nobody wants to rent. This aligns with general business statistics from the U.S. Bureau of Labor Statistics. This isn't theory. Approximately 50% of new businesses fail within 5 years. Real estate investing is no exception, and this is avoidable. Judge by numbers, not emotions. Calculate cash flow on a monthly basis. This puts you on the winning side, not the losing side. Today I'll show you the scientific evidence. What's the biggest mistake most beginners make? Looking only at rental income while ignoring expenses. Let me show you reality. Annual repair costs vary dramatically based on property value and age. Replacing plumbing, electrical system issues, exterior repairs, these are inevitable. But that's not all. Roof replacement costs around $15,000. Typically needed every 20 years, but sooner in harsh climates. HVAC system replacement costs around $8,000. The lifespan is approximately 15 years. Then there's property tax. This is determined by county assessment and tax rates. Before purchasing, always verify past tax amounts and whether reassessment occurs after sale. Insurance premiums have changed dramatically in recent years. Particularly in areas with climate change risk, premiums are skyrocketing. In 2023, they increased by an average of 20%, with some regions seeing costs more than double. Previously, $1,000 to $3,000 annually was standard. Now, expect $1, $500 to $4,000 or more. If you use a property management company, budget 8% to 10% of rent for management fees. However, include leasing fees, renewal fees, and repair coordination costs. Estimate total costs based on the contract. Beginners see $2,000 in monthly rental income and celebrate. But after deducting all these expenses, actual cash flow often drops to less than half of what you expected. The numbers don't lie. Factor in every expense. There's another fatal mistake: underestimating vacancy rates. Many beginners assume a 5% vacancy rate. They think if it's a good property, the next tenant will come quickly. But what's the reality? According to U.S. Census Bureau data, the national average vacancy rate has been running around 6% to 7% in recent years. However, this is based on the rental vacancy rate definition. Depending on location and property type, you need to prepare for 8% to 12%. Let's look at specific numbers. Assume a property with $2,000 in monthly rent. At a 5% vacancy rate, annual vacancy loss is $1,200. But if the actual vacancy rate is 12%, annual loss $3,840. That's a $2,640 difference. Why are vacancy periods so long? From tenant move-out to the next occupant, there are multiple steps. Property cleaning and repairs, advertising and showings, screening and contract procedures. Check recent regional reports and competing property listings to understand your area's reality. Even more important, it's not just vacancy rates. There are times when rent doesn't increase as expected. When supply increases, leasing conditions soften. Set conservative rent growth assumptions for renewals. Optimistic vacancy assumptions are a primary cause of cash flow failure. Plan with realistic numbers. What's the most unpredictable risk in real estate investing? Tenant problems. There are 3 traps. First, non-payment of rent. Tenants suddenly stop paying. You lose months of rent and incur legal costs. Second, property damage. After move-out, you see holes in walls, ruined carpets, an unusable kitchen. Repair costs balloon to thousands of dollars. Third, eviction proceedings. If tenants refuse to vacate, legal action is necessary. Attorney fees, $2,000 to $5,000. Court process, 2 to 6 months. During that time, rental income is 0. What's the root cause of these problems? Inadequate tenant screening. Document your screening criteria in advance. Follow FCRA notification procedures. Comply with fair housing laws. Then verify credit scores. Require proof of income. Contact previous landlords. Consistently applying these 3 steps prevents you from paying a high price later. Prevention is the best strategy. How destructive are market timing errors? The 2008 financial crisis is the answer. Many investors made 2 mistakes. First, buying at market peak. From 2005 to 2007, real estate prices were skyrocketing without limit. Believing prices will rise forever, they bought properties at inflated values. Second, selling at market bottom. From 2008 to 2010, prices plummeted. Driven by fear that they'll drop even more, they sold at rock bottom. The result? According to the S&P CoreLogic Case-Shiller Index, prices dropped approximately 30% nationally. In some hard-hit areas like Las Vegas and Phoenix, over 50% of property values were lost. Those who sold emotionally locked in massive losses. Market cycles repeat. Recovery phase, expansion phase, peak phase, contraction phase. Understand this cycle. Don't buy at the peak. Don't sell at the bottom. Judge by cycles, not emotions. Leverage is a powerful weapon in real estate investing, but use it excessively and it becomes an express ticket to bankruptcy. Let me show you a concrete example. Assume you purchase a $500,000 property with a 10% down payment, $50,000. Your loan amount, $450,000. What happens if the market drops 10%? The property value becomes $450,000. Your equity? 0. If it drops further, you're underwater. Even if you sell the property, you can't pay off the loan. Your choice. Inject additional capital or declare bankruptcy. And now, the situation is even tougher. From 2024 to 2025, 30-year fixed mortgage rates have been running in the 6% to 7% range. This isn't the era of borrow money and profit anymore. Borrowing costs easily exceed returns. The risk of negative carry is high. Low down payments create other problems. Monthly payments increase. Interest rate risk magnifies. Emergency options decrease. Investment property loans often require higher down payments. Match product terms and maintain equity that can withstand price drops and vacancies. Additionally, prepare 6 to 12 months of payments as emergency funds. Leverage is a tool. Use it correctly. Especially in today's high-rate environment, more cautious leverage management is required. What's the final fatal failure? Insufficient due diligence. Due diligence means thorough investigation before purchase. There are 3 essential items. First, property inspection. Have experts thoroughly examine structure, plumbing, electrical, roof, and foundation. The cost is typically $400 to $600, but varies with property size. Inspection costs vary by region and square footage. Focus on high-cost areas like foundation, roof, and plumbing. Skip this, and you'll face tens of thousands in repair costs after purchase. Second, title search. Verify there are no ownership issues. Liens, foreclosures, boundary disputes. Miss these, and you're dragged into legal trouble. Third, area analysis. Demographics, employment, school quality, crime rates, future development plans. Research everything. Properties in areas without demand stay vacant forever. And in recent years, there's one more critical item. Disaster risk. Check hazard maps. Verify insurance underwriting conditions before purchase. In some areas, disaster risk causes insurance premiums to skyrocket or underwriting conditions to tighten. Some insurers are withdrawing from certain regions entirely. Finding out you can't get insurance after buying the property is too late. Why do many people skip these steps? I want to buy quickly. I want to cut costs. But the price you pay later is 10 times higher. A few $100s of investment prevents tens of thousands in losses. Research thoroughly. Now let's organize today's key points. Here's today's summary. First, numbers-driven decisions. Decide by numbers, not emotions. Cash flow, vacancy rates, repair costs. Calculate everything realistically. Eliminate the emotion, "I like this property," from investment decisions. Second, complete expense calculations. Don't just look at rental income. Repair costs, major repairs, property taxes, insurance premiums, management fees. Factor in everything. Insurance premiums are skyrocketing in some regions. Assume vacancy rates of 8% to 12%, not an optimistic 5%. Factor in scenarios where rent doesn't increase as expected. And in today's high-rate environment, borrowing costs squeeze returns. Always run stress tests reflecting current interest rates and insurance quotes. Third, thorough due diligence. Don't skimp on $400 to $600 for property inspection. Eliminate legal risks with title searches. Verify demand through area analysis. Check hazard maps and insurance underwriting conditions before purchase. This investment prevents tens of thousands in losses later. Do you want to be on the losing side, or do you want to be on the winning side? The choice is in your hands. Judge by numbers, research thoroughly, eliminate emotions. That's all it takes. Share your strategy in the comments. The failures you avoided, the lessons you learned, your success stories. Everything becomes wisdom for this community. Thanks for investing your time with me today. With the right knowledge and strategy, real estate investing is a sure path to financial freedom. This channel provides investment strategies based on numbers and reality. You can be on the winning side too. If you want that certainty, hit subscribe. Turn on notifications too. Until next time, keep building.